Well, like I said, a heck of a lot to cover. So let me share my screen straight away and go to that. You should be able to see the screen well as we kick off. And I've got Gordon, Serge, David, Carl, Eric, Theo, Ian, Edward, Barry, Ravi, my old friend, Fred, Paul, Mark, Giles, everyone else on here as well. Welcome one and all. Now, these are the people who are on this webinar. I'm going to share with you in this webinar not only some of the fish that I've caught, no, it's not only the stocks that I've bought, but also the process I think you should be using. And I'm going to share with you a little flow chart of which says basically, what should I do, Alpesh? Basically, what should I do with an existing portfolio? And it's a little flow chart I use myself. Makes life a lot easier than sort of fumbling around with a magazine article here or there or whatever. And I'm also going to share with you a flow chart on what should I do with cash. Some of you will be topping up your ISAs for next year or your SIPPs. And you'll want to know what to do with the cash. How do you make that decision? What's the process? So I'm going to share that with you as well. I'm just going to click a button down here, and that'll help me make sure that I've got everything set up. Yes, there we go. Because I'll be sharing, as I say, this little, well, I'm going to put it on the screen now, just as soon as Microsoft behaves itself. This little flow charts, that's what the flow charts are going to look like. I'm going to share those with you later in. I'll explain these with you for you as well as we continue. These make life so much easier when you don't have to keep on thinking, well, what do I do now? What do I do now? And you can get on with other things. These are the people who are on the webinar. As I said, everything from pensioners to 20-somethings. Everybody who is suspicious of their IFA, whether they're giving good advice or wants to ask the right questions. Everyone who's being charged high fees by boutique fund managers and wealth managers and have read the bad reports in the press, or their investment trusts, or are just wondering, wait a minute, how come my pension's going down? Shouldn't it be going up? And all of these things. So this should equip you with what to ask. And actually, if you want to take charge of things yourself, then how to do it as well. And for those who are at the younger end of the bracket, it's going to help you to make sure you're set up for the rest of your life. Those who are older on, it's to turn that ship around if you've had an underperforming pension. So now that we know what this is all about, let's carry on and get on with it. We'll have a Q&A section at the end as well. Thanks, Ravi, my friend. Thank you. Hi, Barry from Watford. Like I said, everyone, let me know where you're from as well, and grab a pen and paper. You might want to take notes, but if nothing else, the cell phone. So first things first, this is not individual specific advice because I do not know you individually, so I cannot give you individual advice. This is for information. It's an educational webinar. It's part of my campaign for 1 million to teach 1 million people how to be better at investing. It follows on from the 18 odd books that I've written. You should be able to see one of them there, Mind of a Trader. Sorry, not Mind of a Trader, Investing Unplugged. And it's got a whole bunch of information. I used to, when I wrote that book, there were 3 particular sources of academic research that I'd use. And then I would talk about them on my Bloomberg TV show, my Financial Times columns. All 3 of those individuals went on to win the Nobel Prize in economics. They were that good. I just copied what they were teaching and turned it into simple language. And that's what I'm going to be doing here. I'm standing on the shoulders of giants and then just translating it into simple language. Those individuals, by the way, were Richard Thaler, Daniel Kahneman, and Eugene Fama. And they all went on separately to win the Nobel Prize in economics over the last 2 decades. So I'm going to give you that information, plus obviously my own research, my own expertise, everything from my columns and how we've been doing. My own background, I have no conflict of interest with you. I am not a broker, so I'm not trying to get you to use my brokerage service. I'm not a long-only retail investment trust manager or a wealth manager for retail clients. So I'm not a St. James's Place or a Hargreaves Lansdowne or any of those, so I don't have a conflict of interest with you. My interest is a carry-on from when I was writing these and writing in the Financial Times, which is a continuation of that, to make sure that I can educate as many people as possible on how to be better at investing. It's as simple as that. Our own funds, in my own sort of day job on asset management, we are in private equity, venture capital, and hedge funds, and all our investors are institutional because retail is not allowed to invest in those categories. So there is no conflict with you on that. Let's start off with the S&P 500 and where we are. Now, this is my starting point. And those of you who might follow my Telegram channel this channel will know, and if you don't already follow it, I'll give you the links to follow that, will know that I do a weekly update. And in that weekly update, I pretty much decide where I am in the markets and whether I want to buy some stocks or whether I want to stay well clear. Okay. And hi, Simon and Sam, David Cardiff as well. TikTok, Michael from Reading. A hell of a lot of people find me on TikTok. I've got 110,000 followers on TikTok. I think it's 112,000. So the S&P is where I'm going to start off with. And what you see there is basically how I'll determine whether I'm risk averse or not. Now, remember, in my SIPP and ISA, I can invest in US stocks or UK companies or wherever I wish. So it makes life pretty easy because I've got 10,000 companies to choose from, not just a narrow group. But before I get into any of those, I have to decide, well, is the broader market likely to go up or is it most likely to go down? Now, I'll tell you why this is important, and I'm going to zoom in because it might be a bit difficult for you to see otherwise. Okay, you can see how since January, this is it, January 2022, almost to the day, it just kept moving lower. It had some movements where it was going up, but how do we know whether those are genuinely up moves or it's just a rally in a bear market and then it falls off again? Now it's found some kind of support, nothing which makes me overly excited. You can see here, I'd even said there's a 15% likelihood of a worst case scenario. It drops another 20% from there. It seems like it's avoided that. Am I risk loving, risk averse, or risk neutral? Those are the three categories I ask myself first before I even think about buying stocks. And at the moment, I'd probably say I'm fairly risk neutral, but there are some stocks I've bought today which I'll share with you. And risk neutral means I've got to be really picky with the stocks I pick. If I'm risk loving, pretty much can buy anything and it's going to go up, you know, like from basically down here, January 2020 to January 2022, you could pick anything. You know, you should be risk loving because everything was going up. In a falling market, you're risk averse, which means you want to buy nothing and probably hold cash. And risk neutral means you want to be really selective. Okay, really simple. I keep things really simple. I'm a simple person. Now, at the moment, as I say, I'm risk neutral. I'm starting getting ready to buy a bit more, and I'll show you why. You see this line here, this blue line, which is a measure of momentum, that had peaked and started falling after January 2022. It just started falling, and that gave a pretty good clue that the market would continue falling. Now, for almost the first time since January of this year, it's flattening. In other words, we're getting something of a base, and you can see what's happened since January, the market sort of going sideways. So it makes me risk neutral from being risk averse, which is what all of last year was, where I wanted to hold cash. And those who follow me on there, I held about 80% cash. We bought some energy stocks, and that was just about it. Okay. Of last year. Now it's getting a little bit flat. So I'm starting to get a little bit ready. I bought some stocks in January. I bought some today. I'll tell you which ones I'm looking at in a second. Starting to get ready. Okay. Doesn't mean I might necessarily do it tomorrow morning. Something bad might happen and we get out of the market entirely, which is why I do that weekly update, because the markets are just changing too quickly. You need a weekly update when the market's like this. You don't need it when it's going up like this. Nobody needs a weekly update when it's going like this, because the weekly update is, yeah, buy anything, it's going to go up. That was the weekly update for a couple of years. Now it's become, yeah, we better know whether we're risk averse or not. It's a little bit more difficult. It's trickier. I'm afraid. I wish it wasn't. But there are still some good companies, and the ones that I can trust I have a very simple rule. Okay. This goes into my wife's SIPP or ISA or my son's junior ISA. I don't want them being upset at me. That's why it's so important. I got to get it right. Forget you guys being upset at me. We might never meet. I got to meet my wife and son every night. So that's a pretty good due diligence process. I don't get paid either way like those retail fund managers who, yeah, Mr. Jones, sorry, you lost a bit of money after 5 years. I know we've never met. Thanks for the fees. That's not how it works for me. Okay, so I've got to get it right. I've got to justify myself. I've got to be able, and there's a reputation of 2 decades to live up to as well. So what I'm telling you is exactly what I'm thinking. It is not, oh, let me try and sell you my retail ARK Invest fund or Scottish Mortgage or whatever, Fundsmith. It's none of that. I'm telling you the way I see it. Right. So at the moment, there is still some cash for me to deploy. I haven't deployed it all. But yeah, I'm getting ready. And I'll tell you on the flow chart, well, what do I do then? Do I wait until, say, April? Or do I start edging into some selective stocks? Yes. And also I wait till April for the rest of the cash. I don't go in both feet. So that's the first thing we've got to decide. Are we risk averse, risk neutral, or risk loving? How do we decide that? Well, I think the best place to decide it is the free Telegram weekly update that I do. And I also do it on my YouTube channel. There, see, cash. What should I do, Alpesh? Well, are you risk averse? You'll wait a month and see what happens. Or if you're a little bit more risk neutral, you average in. And we'll come to a bit more risk loving in a second, which is not what I am at the moment. Okay, so that's that. Which have I bought more of? I already had these. And I'll go into the analysis for doing it. And these are for my pension and ISA. So there's 4 companies I hold almost forever. And the rest out of the 10,000, I will have to due diligence. And I'll give you an example of how we due diligence those. See this? That's how we do it. And I'll show you how you make one of these yourself at home, almost like Blue Peter. That's 10,000 companies. Now, why do I analyze 10,000 companies, of which, by the way, 9,900 are not worthy of being in my pension, my wife's pension, or my son's ISA? Okay? Because I keep squeezing the criteria until I get what should be in those ISAs and SIPPs. I make it harder and harder for them to get in. The reason I look at things like this is this. Those are 10,000 CVs who want to manage my inheritance, my son's inheritance, and manage my pension. Therefore, I want to look through 10,000 CVs. I don't just want to pick by, oh, I bumped into a person I read about on Investors Chronicle. I'll give them my life savings. Not that stupid. Oh, I came across Scottish Mortgage or St. James's Place. Oh, that'll do. Here's all my life savings and I'll keep paying you fees no matter how badly you perform. Okay? No, that's just stupid. I won't do that. What I'll do is I'll go through those 10,000 companies. But equally, I know that I've got better things to do than just be looking at Excel spreadsheets. So we've got to make that process simple and easy. And what are the criteria that we look at? Well, the first point I want to make to you is 10,000 companies is what you should be looking at. If you're only looking at a handful of name recognition ones you stumbled across, then you're clearly not doing your due diligence. I mean, imagine you're running a company and somebody you bump into at the pub says, oh, I'll work for you, geezer. Or or you're looking for somebody, a plaster and decorating. You go, yeah, I just met somebody at the pub. It'll do. It's just too random. You're asking for trouble. So we're going to improve your processes to increase the likelihood of you making money for a start. Okay? That's the first thing. Now, why did I buy more of this today? Well, because there's 4 what I call quality companies, which I'm happy to purchase more of if they fall and continue holding forever. They happen to be, and you can disagree with me on these. Don't worry if you do. Apple, Alphabet, Amazon, and Microsoft. You can disagree with me. It used to be Meta, but not so much now. Okay, those 4, right? Now, why did I buy more of it? Well, I think it's pretty much bottomed out there. It dropped about 41%, and now it's starting to move higher. Best case, it goes up 33%. Base case, it just sort of drags along this bottom level here. And by the way, when I say base case, best case, it goes up 41%, and there's a 33% probability of that. Base case, there's a 33% probability of that. It goes up 11% in a year. And bear case, there's a 15% probability of that. It goes down 34%, and the other probabilities are everything in between, okay? And that's a guesstimate of that. And I think it's more likely to be this best case and give me a 41% return over 12 months. And I'll explain to you why my threshold, my hurdle rate is 40% for the stocks I pick. I don't always get it. COVID happens, you don't get it. What can you do? COVID happened. Financial crisis happens, you don't get it. But they've got to be able to be reasonably likely to do it. And I'll show you how you should have the same criteria and how you decide, are they good enough reasonably to do it? It's like picking footballers in a football team. They might not go and score you all the goals you thought they would on paper, but hey, at least you did the due diligence and picked somebody good enough as opposed to throwing darts at a dartboard. So that was more purchased of. It seems that the trend's in place. More importantly, the momentum has stopped falling, has seemed to have flattened a bit like the S&P 500, of which it's a component, and seems gradually to be moving up. I suspect it won't go up in a V shape. It'll take a bit of time. NVIDIA. Now this, if you followed my Telegram, you know I got into in January, and thankfully it's worked out. And I say thankfully because I can't see into the future. I wasn't guaranteed it would work out. I could make some comment to you about silicon chips and demand in everything from our cars to our hairdryers, but can I see into the future? No. Do I have a crystal ball? No. What we did instead is we went through the valuation of the company, and I'll come into all of these bits later. Valuation, revenue growth, income, cash flow, all of those things. And that's what I'm going to teach you to make sure you tick those boxes, and you can do it relatively quickly. There, value, growth, income. Croki is cash flow, momentum. Sortino is reward versus risk. But we'll go into all of this, as I say, in a second. And then purchased it in January. So if you followed it, it was probably the best one. Tell us the worst one, Alpesh. I'll come to the worst one so far. It's a bit early because we hold things for 12 months and then we review. Why don't I hold it forever? Well, because the world moves too quickly. I might review it after 12 months and consider holding it, but why would I not go back and say, you're all sacked from my portfolio? Right, let's now pick another best 20 odd candidates out of 10,000. It's a lot more rational than, oh, you're in my portfolio, so I'll keep holding it because guess what? There is no correlation between what's in my portfolio and its performance in the next 12 months. There is between valuation of a company and what happens in the next 12 months, the growth of a company, dividend yields of a company, and what happens in the next 12 months. So just because it's in Alpesh's portfolio is not a reason to keep holding it. And 12 months, 20 years ago, I would have said, oh, you hold it for 5 years. Used to be the case. The world just moves way too quickly now to hold forever and somebody get a free pass. A 10-year for life doesn't happen in my portfolio, I'm afraid. But you might get some stocks, maybe an NVIDIA in 12 months, I look at it, it still qualifies on all the boxes that we're going to tick, and I'm going to show you how to pick and tick. So this one, I expected 116% return over 12 months. It seems to be getting there a lot quicker than I thought, but we'll see. We'll see what happens. And what do you do when a stock overperforms quicker than you thought? So I'll go through the flow chart on that as well. The flow chart on that in this webinar as well, which is, well, what do you do in the middle of a portfolio? What if it's done incredibly well and you start getting a bit risk averse? Well, you might sell 10 to 100% depending on your risk appetite. It's bespoke to you. Remember, it's not about what is the future, Alpesh. Should I hold on to it? Can I be like you, Alpesh? No, it's not that. It is actually, you know what, Alpesh? Between all my other concerns in life, I've got a bit more risk averse. I've made 100% on this stock. I think I'll sell half of it and let the other half ride or whatever. It's got to be bespoke to you, not you trying to take on somebody else's risk appetite, which otherwise will make you blow up. And you've got to be able to wake up at 3 a.m. and say, oh, okay, that stock's fine because I looked at the value, growth, income, cash flow, volatility, and it only takes you 10 minutes every fortnight just to keep an eye on your portfolio. Is that too much to ask? No. The way I'm going to show you, no, it's not. As opposed to you wake up at 3 a.m. and go, you know what? I just picked that stock because a bloke at the pub told me, or Investors Chronicle, or whatever. Shares Magazine I happen to read and ask. I love Investors Chronicle, but, it's got its place. I won't pick a stock just because it's in there. It's got to be due diligence across 10,000 other companies who have to fight it out to see which are the best on value, growth, income. Remember as a child, you had top trumps, those cards, and you'd say, well, my valuation's better than your valuation or whatever else. I should create that game, actually. This is what we do. We make them fight it out until there's only 100 left out of 10,000. Otherwise, my wife will kill me. So let's just go into, before we go into some more of the stocks that I've purchased, and I teach you how to do it yourself. So I'm going to throw you some fish and I'm going to teach you how to fish. I'm going to throw you some fish and I'm going to teach you how to fish. Okay. First things first, let's just talk a little bit about, let me give you a bit of context. Now, this is a foible of mine. And you might think, oh, I don't care how they destroy our pension, so I won't take long on this. This is how they destroy a pension. If you are in employment at the moment and you don't know where the money coming out of your pay packet, which goes into a pension, you don't know where your employer is investing that because they make the decision who the fund manager is going to be. And they've put it with Blue Whale, which last year was down 27%. Then that's worrying. Or an IFA that picks it. I put this on Twitter and this IFA started arguing with me saying, well, it's reasonable. I said, that's in a pension, for God's sake. How can you lose 27% in a pension? Yeah, well, maybe they only put a little bit in. Yeah, anything over 0 is too much. And Blue Whale's a well-known fund. There might be others. You need to speak to your employer and you need to say, who is my money with? It's your retirement funds. Who are they with? And then find out who it's with and ask them, can you have a list of what you've invested in and what your performance is? So you can see, at least you can ask and find out your pension. It amazes me how much people just stick their head in the sand and hope it's fine. There's another reason how fund managers destroy value, and most people don't realize this. A fund is not picking for an absolute positive return. So when I'm picking for my SIPP and ISA, and what I'm teaching you is how do we get 10, 20, 30, God willing, 40% in a good year? 2021 was a fantastic year. Maybe we get 50%. Last year was not. Maybe we're lucky to get 5% or 10% last year. Okay. The point is, or maybe there's some years, like 2008, you get a negative return. That was me, 2008. Hell yeah. It's the one I remember the best. I think 2018 was as well. Okay. But we want an absolute return. Fund managers don't do that, just in case you didn't know this. What they do is they look at the weighting of individual stocks in an index, because they're just trying to beat the index because they get to keep their job if they do. And that's how marketing's done. And by the way, the majority, more than 50%, do not beat the index. Thank you very much. And they charge you fees for the privilege of not beating the index. They just try and weigh it according to the index and take a guess or a gamble that, well, 14% is Microsoft. We'll just put 5% in our fund. So they balance the index so they can try and outperform it. Okay, they'll just try and move things around so they try and outperform the index. Well, that's no bloody good, because if the index falls, they'll turn around and say, which it does 33% of the time, they'll turn around and say to you, oh, we beat the index. Yeah, but you lost me 10%. That's all right, but we beat the index, didn't we? That's one other way in which they do it. Okay, now, how do IFAs, independent financial advisors, for those of you who've got one, destroy your pension? Well, here's a great article from the Times. That was from slightly over a month ago. Just over a month ago. February 2023, 1 hour of pension advice cost me £6,000. That's one way they do it. You don't know, they keep charging you fees forever. Wouldn't it be great if you just knew, okay, I'm going to pay this and that's all I'm ever going to pay for the rest of my life? £6,000 for 1 hour pension. That was one of the scandals the Times had revealed. I'll show you some more that you don't realize. By the way, all their kids going to private school and they're all driving around in Porsches, nice. How you destroy your pension. This really annoys me. This is Scottish Mortgage Investment Trust. It's one of the ones which I get a lot of my students coming up to me and saying, oh, I bought this, and for years it did well. It did well because it just basically bought a load of tech companies, which did well. And congratulations for them for doing it. So many didn't, so congratulations. It's just that there's a slight problem. You've lost 50% in 18 months, not even 18 months, in 15 months, you've lost 50%. 50%. And why did people buy it? Name recognition. They kept hearing it. I wrote a column in the Financial Times many years ago where I said, name recognition, the academic research shows, and it came from Eugene Fama, who then went on to win this Nobel Prize in economics, showed that name recognition is one of the critical reasons that people pick stocks or pick funds. I mean, seriously? Does that sound like does that look? Is that how you should do it? Or should you have a proper approach, which isn't too difficult, honestly? I'm going to show you, not that one, I want to show you this. Okay, those are exchange traded funds. There's 5,000 of them, but I still need to filter them. Okay, shouldn't you be, instead of name recognition, you might say, oh, digital revolution, that sounds good. Hotel, airlines and cruise, next gen connectivity, or whatever else, quantum. Whatever, sexy names. Yeah, but we need to look at some of the data, especially the Sortino and the Alpha. I'll explain what those two things are. And is it worth the effort, Alpesh? Well, it is, because if you make on, I don't know, let's say you've got 100,000 and you make an extra 10% because you took the effort, well, that's 10K this year. And if you've got 500,000, you make 10% extra, that's 50K this year. Is it worth the effort? Yeah, bloody hell, yeah, for an extra 10 minutes every fortnight, I think it is. Okay, it's the best side job you'll ever have. So that's the other reason and way you destroy your returns. And if you want to see the data on it, this is from JP Morgan Asset Management. That's average investor, 8.7% return since 2012 to 2021, which, by the way, included one of the best bull markets ever. That's the average investor's returns, 8.7%. Half of what the S&P 500 index would have done. You would have been better off just having an index tracker. And by the way, that's usually the case if you can't be bothered doing anything. Just have it for a long period of time, though most of us want to do better than that. We want to at least do 50% better than an index tracker. And you might say, oh, you're never going to do it. Well, fine, just have an index tracker if you're not going to believe that. That's fine. But the average investor does half as well as the S&P 500 index. So you mess it up yourself. How? Well, sometimes you overtrade. Sometimes you give it to investment trusts. Sometimes you just don't do the due diligence. You go on name recognition of the next big thing. So you buy it when it's already gone up. It's overvalued. It's not growing. It's got paying next to no income. It's got poor cash flows. These are all the reasons. These are all the reasons. So how do we avoid these problems? Well, we do the exact opposite. Okay, and I'm going to show you that. This is an article from 2020. More than £1 trillion of Muppet money costing savers billions. Eye-watering 1.5 trillion cash is stored in savings accounts spread across ISAs and bank accounts, according to the Bank of England, an amount equal to the combined value of all UK residential mortgages. It's just sat there, which is fine. Why is it sat there? You might want a nest egg, and you'd be right to have a nest egg, some money just for a rainy day, and that's fine. But usually it's sitting there because poor you, and it's not your fault. Nobody ever went around and showed you a process for doing it yourself. And they never had the incentive because they wanted you to use their expert services of an investment trust, a Scottish mortgage, or a St. James's Wealth, because they wanted to, like the Wizard of Oz, sort of hide behind a cloak and say, oh, leave it to us and charge us the fees, please. Give us the fees. Okay. And of course, it's not easy either. We've got to simplify it. You got to look at all of that. Do you want to do that on a Sunday afternoon? I do. I love it. I love this. I absolutely love this. But you probably don't. Okay. So what we want to do is simplify it. And just to drive this point home before I get on to teaching you how to fish and some more of the stocks that I particularly like, and I've got about quite a few presentations to show you in terms of what I like and so on as well, is, and I'm going to go into the FTSE 100 there, and there's a whole bunch of stuff I've got to take you through. So I don't, I want you to know we're going to go through a whole load of stuff there as well. This is how most people end up buying stocks. It's an absolute bloody mess. They never go and clean it up. They pick it up sporadically, spray and pray, thinking, oh, I'm diversified now. I've got a fund which mentions Japan. I've got a fund which mentions Europe and one which mentions growth. And those funds, each one of those funds has 100 stocks in it. So in total, they've probably got close to, thank you, Ravi, my friend. They've probably got, I better share that with people. I'll share that in a bit. They've probably got about 500 stocks in their portfolio. Well, that's pretty bloody useless, because actually it's going to dampen any growth they could otherwise have had. And then they don't know what to do to get rid of it. In fact, they never want to look at it, because if you've got so many stocks to look at, who wants to look at that and analyze that and know when to get out? That's why we have a hard stop of 12 months, or if it drops 25% from the highest it's been since we've bought it. Simple as that. Keep it really simple. Sometimes I might tweak those, but that's up to me. And you might tweak them for your stocks. That's up to you. But I keep it simple at the entry point, because otherwise people just don't know when to let go of the bloody stock. And then they hold something. They go, oh, I've still got HSBC. And I said, well, that's a 1997 price. He goes, yeah, but it had a really good year 15 years ago. So I hold on to it. Oh, okay. You do know the opportunity cost of what you've missed out on. No, but it's all right. Fine. Okay. Could be worse. They could have blown it at Vegas, I guess. This is what we're going to do. You get all these names, and then we're going to put them through value, growth, income, cash flow checklist. Can we tick the box? Are they undervalued? Are they growing? Revenue growth? Are they undervalued? In other words, share price compared to profitability? Are they paying some dividends? And I'll tell you what these things are. And you might say, wait a minute, there's companies which are overvalued, aren't growing, pay no dividends, but suddenly jump up in value. And I'd say, yeah, you're right. We're just never going to get them in our pension, because, sorry, it's just too high risk. If you want to take risks, go to Vegas. I'm not the person you want to come to. And yeah, I have a 40% hurdle rate. Don't always achieve it, but that's the hurdle rate. Now, in the UK, it's 20%. If I was just picking UK stocks, it'd be 20%. Why? Well, because that's the UK for you. It means it just doesn't grow as much as the American companies. And statistically, you'll see it's a 2-to-1 ratio. Over the long term, not any given year, but over the long term. Okay, we're going to do that, hold for 12 months and then repeat the whole process. And some of the stocks might reappear and stay in your portfolio, 15 to 40 stocks. And I'll explain to you why not lower than 15, and you don't need more than 40 to be amply diversified. Okay. The sources of our data, well, I said no Nobel Prize winners, but also there's ample research out there. This study, what's worked in investing, there's ample research done out there. There is a ton of data which has been crunched, as you would expect. There's a ton of data which has been crunched, and we just copied all of that. And the thing that we realized, contrary to what retail fund managers would have you believe, is this. We know undervalued companies tend to perform better than overvalued ones as a general rule, but not as a guarantee. But we know valuation isn't the only factor which moves stock prices. We know growth companies tend to do better than companies which aren't growing as a general rule, but not guaranteed. Okay. We know companies generating income. It's an important factor, but you can have non-dividend paying ones which might do well, which are overvalued and low growth. And it can happen, but we don't need to worry about those. We're going to exclude all of the ones which don't tick all the boxes, because we don't want to gamble on, is the market ready for value or growth or income? Now, asset managers like a Vanguard or a M&G or a Fidelity, they have all these adverts, very expensive adverts, all over the billboards in all major cities, because they get paid fees on the amount of assets they collect. So it's very simple. If we spend £1 million on adverts and we collect £10 million of assets, we better do more adverts, because they get paid a percentage or 0.5% or whatever it is of the money that they're managing. That has two problems for you, and it's not the fees which are the major problem. The major problem is this. That means in a falling market, under their own mandates, they can't just go to cash. You're not going to pay them 1% just for holding cash when a bank will pay you 2% for giving them cash. Okay, so they have to stay invested, which is why people like Cathie Wood have sunk, because they had to keep holding those stocks even though they were falling, and then try and talk them up deceitfully, lying last year, saying, oh no, tech's still going to be great, blah, hold on for 10 years. Why couldn't they just say, you know what, looks like it's going to be a bad year, we're going to get out into cash, we'll buy back cheaper in 9 months? Okay, and they used the excuse, oh no, you don't want to try and time it. No. Well, actually, we could see the momentum was in one simple direction. Okay, but anyway, forget all of that. We need to tick the boxes of valuation. Now, there's a lot of ways of valuing a company. There's price to profits, i.e. price earnings. There's price earnings growth. There's price to book, price to sales, discount cash flow. Which one are we going to use? So we looked at the academic literature on that. And we know from that literature that valuation should be given a weighting of about 40%. You know, it's the most important factor. And dividend yields, they're only about 10% weighting. Okay, so we put all that together. Momentum is important. In other words, trends tend to persist. It's not the most important, but it has some importance. And there's something about statistics. How volatile is the company? Less volatile companies tend to, over the long term, perform better than highly volatile ones. Guess what happens? Highly volatile ones make the news because they're volatile. They're interesting. Journalists write about them. They get you name recognition. The research shows they're not the ones that perform well. Daniel Kahneman, Nobel Prize winner, have a look at his. Richard Thaler, have a look at his work. Both emphasize this part, and to some extent, Eugene Famer is not Nobel Prize winner. This point, okay? So what we did is we said, well, we need to incorporate those factors: value, growth. Where are we going? Where we go? I'll throw you the Dow. We've done the analysis for the Dow. We want them to meet our minimum requirements on value, growth, income. So anything which is 7, 8, or 9, we created a little proprietary thing, but I'll show you how you can create your own in a second. Okay, cash flow, which is croaky, and I'll show you how you create your own version of that. Yours won't be identical to mine, but at least you'll be able to have something which is similar. 6 months ago, the performance, Sortino and Alpha will come to, and it had to tick all those boxes. Well, actually, nothing on the Dow other than Visa at the moment ticks those boxes, and sadly, it's a little bit overvalued anyway. Okay, but it had to tick all those boxes for us. And if it doesn't, sorry, not good enough. Because when I wake up at 3 in the morning and let's say, I don't know, I got into American Express and it's fallen, I don't want to have a cold sweat and say, shit, why did I not look at the valuation of the company and that it was overvalued and now it's fallen? I don't want to have those second doubts. Okay, I need to be able to stick with it. So the most important thing I can teach you is you need within the strategy to make sure you're ticking the valuation. Now for that, it's fine if you look at price earnings and give that the most weighting. Growth, I want year-on-year revenue growth. You can write this down if you wish. Income, some kind of dividend yield. Doesn't have to be big, because whilst it's not guaranteed it'll give you a better return, the data shows it gives you something of an edge in terms of likelihood of better performance. Cash flow. Now, I use cash return on capital invested. I'll show you that in a second. It's invented by Deutsche Bank and used by Goldman Sachs Wealth Management. They discovered companies were in the top quartile, the top 25% by cash return on capital invested, generated 30% per annum. Yeah, you heard that right. In share price performance. Not every company which is in the top 25% or by cash return on capital invested, and not every company every year, but on average over the long term as a basket, 30% per annum. So we want to tick the cash flow box. You might use a different version. If you look at Yahoo or whatever, you can get a cash flow box to tick. Outperformance. This is a measure of alpha. Does it outperform the market? And volatility, I ideally want it to be below 20%. Okay. Now within that, tactically, you might say, well, which guru owns it? Which analyst? What's in the news? Geography, I want some exposure to the UK market. So you might pick something, or I want small caps or large caps, or I want certain sectors. That's up to you. I don't particularly care, and I'll show you that in a second. So you eventually end up with something which hopefully looks a lot like this. Okay, so you're able to tick those boxes. Now, once we get that, then for us, we will, I just want to show you some more. There we go. So let's say you get an Adobe coming in on it. Well, then I also want to see on the monthly chart, is the MACD flat to rising? Remember, I'm going to hold this for 12 months. It's not something I have to do every day, every week. Okay. It's then done. Then I go play with my son. Okay. It's done. All right. Or a Disney. And guess what happens? Take Disney as a classic example. Bought in January, went up, everything looked great. I was feeling really smart, made 20% in no time. Then it fell right back again. Snakes and ladders. That's fine. That's okay. That's why we hold for 12 months. That's why we don't trade our investments. And we'll see what happens in 12 months. In 12 months, it might still be there. But I'm not guessing because I know it ticked the value, growth, income, cash flow box. Now, you might say to me, oh, no, Alpesh, I watched the latest Disney show. It was a bit boring. Really? Is that your due diligence? Or are you going to look at the 3 sets of accounts all companies produce? Balance sheet, profit and loss, cash flow, because we did. And then we did a statistical analysis, like I said. That's what we did. I'll come back to some more of the stocks that I own. And that's one which hasn't done great. NVIDIA did so far, giving us whatever, 50-odd%, made up for the Disney. So it still averages 25 in the first 3 months. Let's see what happens for the rest of the year. Okay, that's how we want to do it. These are the key numbers you should be using. So I'll throw you some more fish, stocks that I like, because I know that's what many of you are here for, but I'll also give you the process. You need to tick those boxes. If you do not, and you're not looking at a universe of 10,000, don't take my word for it. Just use your logic. You are then fishing in a narrow gene pool with a limited amount of due diligence. Okay? The chances of you thereby then succeeding, it's a bit like crossing the road. Is it a gamble? Yeah, you're crossing it with your freaking eyes closed. It is a gamble. But if you're actually looking both ways, the chances of you getting hit by a car are pretty slim. And that's all this is. When people go, oh, investing's a gamble. Yeah, if you do it with your bloody eyes closed, so's crossing the road. And we're just trying to keep our eyes open. Even then, are you guaranteed you won't get hit by something? No. Something comes up from bloody nowhere, even though you looked, right? Okay. Monitor them frequently because you're not trading your investments. What does 12, 15, 25, 40 mean? It means this. 12-month holdings, 15 to 40 stocks. And if they drop 25% from the highest they've been since you bought it, and I put my money in equally as a general rule into all of them. Okay. One strategy, which is value, growth, income, cash flow. I'll keep mentioning this. Okay, 20 to 40 investments max, as I said, many tactics. So I'll show you what happens once you write those down to the 100, that you've narrowed it down. This is what I send my clients, okay, each month. What happens is you get to a narrow filtered list, and then what we do is we have a tie break. Imagine 2 people come to you for an interview and they got identical CVs. They both look great. That's what happens when they've ticked all my boxes. How do I decide? Well, then I might look at, say, oh, that one's got shiny shoes and a nice tie. That one's got a smart skirt and a, I don't know, perfect makeup, for argument's sake. Relatively irrelevant factors, but we need a tie break. So what we'll then do is once we've done that, we'll say, and here's an example, I'll throw you some more fish, AbbVie. Now, I don't happen to own AbbVie at the moment. So here's one that I don't own. We look at discount cash flow. That's 42% undervalued. We happen to look at this. And the reason I don't happen to own it is whilst it's going in this upward channel, I can't buy everything, and it's a little bit overbought. There's a whole bunch of others here. HireQuest, I'll give you this one because it is one which I was looking at earlier today. I thought, ooh, how come I haven't bought this yet? Discount cash flow. So it ticked the other boxes: value, growth, income, cash flow. Had to tick those first. Then we did a tie break. There we go. Okay, nice little move upwards, momentum there. It wasn't just this chart. That would be stupid. So when people go, oh, technical analysis doesn't work, yeah, you're probably right. We're not just doing that. Techno-fundamentalists, you can call us. We look at the fundamentals, we look at the charts, we look at everything. It has to tick every single bloody box. Belt, braces, the works. Okay? Because otherwise, my 5-year-old son's going to turn around, look at me and go, Daddy, why have I got no inheritance? Spoiled little brat that he will become. That's why. Because I'll have messed it up. I don't want to do that. And then his mum will look at me and you don't want her giving you nasty glances. Okay? That's my best due diligence I can give you is those two scary people. Now, I'll come back to some of those stocks in a second. That doesn't take long. It sounds like it takes long. It doesn't. Monitoring for 10 minutes every 2 weeks doesn't. And I'll show you the flow chart again as to why that's the case. The vast majority of you think the Dow's going to be up, by the way, by the end of the year. I've got another interesting poll to do. It's this. Now, why do I say 15 to 40 stocks? And it gets a bit contentious. I say this on TikTok, people go mental. Okay, it's a great way of getting a lot of views because they start engaging. It's a bit stylized. Now, you might say, yeah, but Alpesh, what if every single company was a tech company? Then I'd say, yeah, well, you're a bit stupid then, aren't you? Just to pick every single company in your portfolio as a tech company. I can't help you. Go see a specialist, right? About 15 to 40. If you have more than 40, the problem is you're not diversifying away any more company-specific risk, and you're just leaving yourself with a headache of monitoring a lot of bloody companies. Okay, it's very easy to, get on the phone and go on to a AJ Bell or a Barclays, buy that, I'll 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 buy that. Okay, that's fine. That's a problem because then you got to monitor and live with that. Okay, so I'd probably say 15 to 20. If I've got some clients who've sold their businesses, they've got many millions of pounds. I've got some students, I should say. Okay. And they say to me, look, I've got about 10, 20 million. I want to have 40 stocks because I want to spread that money across 40 companies, not just 10. I've got others who've got as little as, say, 50,000. They know they're going to get more in the future. So I've got 50,000 Alpesh, student yours following this. I'm going to spread it across 15 stocks, and that's fine. Lower than 15, I start getting worried. Okay. Another one I own from Taiwan Semi. Okay. And this was purchased at the start of the year. So here. So not at the bottom here. It was here. And you might say, why there? Why in January? Okay. And I'd say to you, well, I'm going to see if I can actually draw. Let me see if it draws. That might be clearer. There we go. So it was purchased here. Well, why not here? Well, a bit risk averse, actually. Thanks very much. So I waited for that, and also that trend had broken, and it hit my value, growth, income there. It didn't do it there, right? So it hit it there, and we're doing all right on it, and that's the projection. It may well not do that. Might go sideways and then go up. I don't know. I don't know what's going to happen. But what I'm saying is, it belongs in my team. It's a bit like saying, "Hey, Alpesh, if you're into football, you've got this great footballer, Haaland. Can you guarantee he's going to score me 20 more goals?" No, I can't guarantee it. The chances are there. The probabilities are there, and it's worthy. If I wake up at 3 a.m. in a cold sweat, I'm going to think, well, it's all right. Track record, value, growth, income, cash flow. That's what I've got to get across to you, because the amount of risk people take on their pensions, it is shocking. And they've worked their whole bloody lives to earn this money, and then they don't, A, have it working hard for them, but instead they give it to a fat cat fund manager or a wealth manager who keeps taking the bloody fees, underperforming, and putting the wool over your eyes, because what they're doing is they're just trying to beat an index, as opposed to say to you, look, this is what you could have earned. And then even when the markets crash, they've got to hold that money in the stocks because that's how they're paid. It's just complete self-interest. Tesla, I own. This wasn't on the approved filtered list. This was not on my approved filtered list because it always had too much high volatility. But occasionally on my Telegram channel, I put in special situations. The special situations are where, okay, I can see it. They're usually high risk, as this was in January of this year. and I say, okay, I see that projection. I see that it seems to have bottomed out on momentum. It's likely to do this and then go up. And indeed, it's been doing that and it's gone up. And the run rate is, look, I don't think I'll get 200% in the next 12 months, but it's on track. A bit like those, you know, when you watch cricket, I don't know if you know cricket, and it shows you what the run rate is, you know, and what the target is and how they're doing. It's a bit like that. And it might pull back a bit, but I won't panic. So if that happens, let's say in the next 2 days or 3 weeks, whatever, I won't panic because I know it's still part of a bigger picture. I can see still got that upward trend, got the momentum. And that's what I thought my special situation. So sometimes I love those. When it works well, actually, let me put it another way. When does it work well? And when does it not work well? Well, it doesn't work well when the markets are falling, because nothing works well when the markets are bloody falling. What should happen is these are the kinds of stocks which shouldn't fall as much. Some indeed might even rise. When it's working well, i.e. you've got a tailwind, the markets are rising, then it should give you steroids like this. Now, this is a classic example from 2021. Okay, 12 months, 54% return, and it was a high point. Why is that? Why is that a good educational lesson? Several reasons. One, these were some of the stocks that were on our approved filtered list, which did really well for me, etc. Okay, Alpesh, well, why didn't you just pick Crocs and nothing else? Gave you 208% return. Because we didn't know it would do that. We knew it was on the approved filtered list and it will do well because it ticked the value, growth, income, cash flow, all those boxes. But we had no guarantee it was going to go 208%. If I knew it was going to do 208%, I would have bought that and nothing else. I would have sold every asset I own and just shoved it in that for 12 months, obviously. It's why Warren Buffett doesn't have just one stock, because we could see that clearly. All we know is, all we're trying to forecast is there's a greater probability of a rise than a fall in these stocks, and that rise should meet our benchmark, as all of these did. That's when we've got a tailwind and it does well. The same company may well, in a bear market, have generated 0% because you've got a headwind, a bit like a plane flying from New York to London. Tailwind, you get there sooner. Headwind, it takes twice as long. Same pilot, same plane, same distance, same company, but it took twice as long to get the return. And the other lesson I want to teach you as to why you have more than one stock, and the way I want you to think of things. So you've learned about tailwinds and headwinds. You've learned about you're not predicting how much. You're trying to just get the kind of companies which, if the market falls, they don't fall as far and hopefully still give a positive return. The other thing I want to teach you is this, and this is a great, this is not typical. Oh, Alpesh, why isn't that typical? Have you looked at the markets? Are they like 2001 all the time? No. So this isn't typical because 2001 isn't typical. Ta-da. That's just logic. Okay. Why 12 months? Well, if you look at what happened to Crocs after the 12 months were up, you'll see that it crashed and burned. Well, hang on, that means you picked a rubbish company. No, I got 208%. You should be picking companies based on value, growth, income, cash flow, so that they're like a fruit which isn't ripe, and then they should over ripen, fall off the tree. That's when you eat it, consume it, exit it, basically, then throw it away. You don't wait for it to fall off the tree, over ripened, on the floor, being turned into mush, looking ugly, i.e. then falling, overvalued, ugly, no growth left because it already had that growth in the previous 12 months. You don't hold on for too long. What's too long? Well, we think 12 months is a good measure. Alpesh, why aren't you using clever AI to work out the exact, is it 12 months and 1 day and an afternoon or not? Please, we've got better things to do in life than mess around. So that's why we look at it that way. Okay. And that taught us a lot of important lessons. The good times had lessons to teach us, which is, you stick to the 12 months because we learn after those 12 months, all of those stocks think they'd overripened, they'd got overvalued to the upside, and then it was damn good we got out of them. Okay. So that's an important lesson. And that's what a tailwind does. It's not typical for those thinking that I have a magic crystal ball and that's typical. No, I wish. Okay. Just so you know. Now, assume, therefore, what should we be aiming for? Assume you plan to invest over 10 years, and with my help, you make 20% per annum. Even though you're targeting 40, you only do half as well. Maybe some years you make more, like the 2021 types, 2 years ago type. Some years you make less, like last year. So nothing extravagant, nothing pessimistic, about 20% per annum. Let's say and by the way, you saw the S&P 500 was 16%. Okay, so we're not asking for much, right? Let's say you've got 100K in a SIPP or an ISA, right? You might have more, you might have 1 million, in which case multiply all my figures by 10. And you plan to add 1,500 a month. Now, some of you who are at the younger end watching this webinar will say, you nuts, we don't have anywhere near that. Others of you will say, 100K, I had that when I was 12. Okay, but you know what I'm getting at, okay? Well, you'll have 1 million after 10 years. You'll have converted 100K into 1 million after 10 years. In a way, that's my job for my family. Well, actually, my family expects me to do it sooner, but you know, that's because I'm a so-called expert, but that doesn't matter, right? That's what it looks like. Some of it is the capital contribution, of which you'll do some, so you might as well look at it. So why doesn't everybody do it? And some of you go, oh, yeah, I heard about this. It's called compounding. Einstein talked about it once. It's amazing. Yeah, I know. Why don't you do it, though? I'll tell you why I don't do it. Because for about the first 4 years, your contributions and your returns look about identical pretty much. Okay, you don't feel like you're getting one. The reason you don't do it is because it's delayed gratification. Because in year 9 to year 10, my little boy will be earning about 200 grand in a year for doing nothing. Because his daddy 10 years earlier had set him up. So he'll get 200 grand in a year. I'm not going to tell him. I'm going to keep it. Just blow it on, well, stuff. Let's assume you only have 10K to start with, and you plan to add 6K a year, divided equally each month. So a bit more like somebody who's in a job starting out in their 30s. Then this is what your return would look like. Again, for the first 5 or 6 years, nothing. My son's junior ISA would start off like this. It's those years when they're approaching university or whatever, that's where the returns are. Delayed gratification. That's why people don't bother even starting. It's like, what's the point? For the first 5, 6 years, let's just go on a holiday instead. I'm not saying there's anything wrong with holidays. Do the holidays. Do everything else. If you do happen to have some left over, it's why it's worth starting. Because though it's a bit like the old Chinese saying, the best time to plant a tree was 10 years ago. The next best time, today. It's a phenomenal statement, but that's true. So this is the stuff through my campaign I've been teaching people for 2 decades, okay? These are all past and present paying clients to explain to their audiences why these things are important. And thanks to people like Barclays, book launches and all the rest of it, I'll give you a link to download free copy of that book, just because I like to bribe people who are on my webinar, so they go away and tell other people, hey, that webinar of his was really good. I've written a whole bunch of them, actually, and I've just done all of that, and you know, for the country, etc., and for the FT. That's part of, this is just an extension of that. So let me show you some more stocks. Let me reiterate how we do it, and some more of the ones that I like, okay, as well as, remember, 12 months and reevaluate, that's it. Take a picture of that if you wish. I mean, I can't make it any simpler than that. What worries me is this. This is taken from an actual student of mine. He said, can you have a look at what my pension fund guys put my money in? I said, sure. And then on page 17, we found this. And you won't, yeah, this looks innocuous. Invest £10,000 if you cash in after 5 years. 5 years? Why do they need 5 years? Because statistically, over any rolling 5-year period, you won't have lost money. Well, that's not the benchmark, is it? It's how much should you have made? That's the benchmark, not, oh, I just got your money back. A bank account will not lose money after 5 years. So that's one reason why they do it. I think it is a deceit for them to say that. Recommended holding period, 5 years, because they know after 5 years, they've got enough fees to send their kids to private school on the back of your work. Well, look at what those fees are. Hang on, Alpesh, £1,000 is 10% of £10,000. I didn't know the fees are 10%. I was told they're 0.25%. Yeah, they're lying. It's not 0.25%. There's a whole bunch of charges and hidden charges and everything else they've not told you. Sunday Times did a investigation on that as well. Okay. So there. Now, I believe that managing your own portfolio, the reason the government created SIPP, self-invested personal pensions, is because they know it's not the same as brain surgery. In fact, it's more like driving a car, which is why they let you drive a car, they let you manage your own pension, because it can be learned. And that's part of what I want to make sure you can all do. The rules are value, growth, income. Let's just go back to the full list. Okay, it's got to tick all those boxes: cash flow, momentum, Sortino, alpha. Sortino, by the way, is a measure of average return versus average volatility. Return, i.e. reward, versus volatility, i.e. risk. Reward versus risk. That's all the Sortino is. And when, as a hedge fund manager, it's the thing we're more asked about than performance. We're asked, what's your Sortino? There's no point having a great performance if it was just a volatile high risk, went to Vegas, and that's how I got 100% return. Well, that's pretty volatile. Okay, that's how. Let's just go into that. So with my big mouth, I was asked, well, can you outperform fund managers? And indeed I did, and won that competition in the FT, as you can see over there. Beat that idiot, who in 2004 was, I mean, rubbish back then. We knew in the industry was rubbish, but the media loved him. They loved him because he had a chiseled jawline and he had a, short haircut. Apparently that's the secret to raising 9.2 billion pounds. That and a load of media buff and guff from Hargreaves Lansdown. All of these people who are now being sued for pushing funds which they should have known better about because they were getting fat fees. It is absolutely disgusting how the retail fund management in the city works. And how how corrupt it is in actual fact. Okay, and that's why back then I said private investors should be doing it in my column, and I've been saying it ever since. And let alone the fact that periodically newspapers like the FT will write articles about how active fund managers keep underperforming. Eugene Fama, look him up, F-A-M-A, Nobel Prize in Economics, for proving this statistically. Because they look at too narrow a gene pool. You don't need to do that. You can look at 10,000 stocks, let alone St. James's Place, who just get trashed every single time there's an article, they get trashed for the fees they charge. You can read it there. Okay, and that was from 2020. Largest wealth manager paid most with a bill of 583 million for investments in 18 funds whose performance the firm itself had concerns over. They include 780 million for a diversified fund bond. Anyway, I won't go into all of that. So once you've got that list, and I said what we do is we will look at discount cash flow. I'll tell you something else we'll look at. I'm not going to go into the statistics of it. We might then do a tie break and look at, say, a Miller Industries and say, well, wait a minute, what's the return potential? 35% you can see there. Where did that come from? That's the average of what the analysts had targeted versus where the company's share price is. Well, wait a minute, is that you're picking it on that? No, we're picking it on value, growth, income, cash flow, all of those things. Then finally, oh, okay, we need a tie break. What should we do? Let's look at what the analysts say, which usually we don't like what analysts say. It's pretty rubbish, but we need a tie break. It's a bit like that person's wearing nice polished colored shoes. Okay, it's not essential, but it's a good way as any of tie breaking. There's other ways of tie breaking. Guru buys. Are there any stocks? These are the holdings of the top 10 holdings of some of the billionaires. Do they happen to own any? Yeah, okay. So I own Apple. Not because Warren Buffett does. Last year I owned Occidental Petroleum. I don't anymore. I don't think he does either anymore. Taiwan Semiconductor. I still own. He has. So what? It's not because he bought it. I have Microsoft. Not because the billionaire has it that I have it. It's just that coincidentally we both have it. So Guru Buy could be a good tiebreaker. And we'll look at the hedge fund reports to see that. AbbVie, you saw earlier, looked good. Hedge funds are pretty positive on it. It's a good tiebreaker as any. Okay. Tactic 2, filtered and deeply undervalued. So approved filtered list and deeply undervalued. This isn't this is an example. So don't go for Victory Capital Holdings now. This is an example. The others were all up to date. This isn't up to date. Or everything else has been up to date except this one. It's a slide from before. Okay. Just to tell you. Low volatility. Well, yeah. This, by the way, you can get from Wolfram Alpha if you want to. ChatGPT are about to do an app for that, if those who understand what I've just said. ChatGPT and Wolfram Alpha. If it doesn't make any sense to you, don't worry about it. Okay, and we'll look to see, volatility-wise, what's the likely return? And as long as it's not too negative, yeah, okay, that's a good tiebreaker. It's a tiebreaker once it's in value, growth, income, cash flow. And what happened with McKesson? Worked out like a dream. Do they always? No, there's no guarantees. But at least if I woke up at 3 a.m. in the morning, which I tend to do, actually, oddly enough, now that I've got old, then I'm not going to worry about it too much because, well, this one worked out well. I wish they all did this. They don't all do this. Jointly, analysts over 40%, as I said. Okay, and that. Okay, richest picks. Now, this is my favorite. This is my absolute favorite. So I stole this slide from Goldman Sachs Asset Management ages ago. Some of you will know this story. About 10, 12 years ago, I was at a lunch. The hedge fund manager, you get out, invite to a lot of staff. They invited us to a lunch. I was sat next to Jim O'Neill, now Lord O'Neill, and their presenters from their Goldman Sachs Research Quantum Database presenters with this. Now, this is a formula invented by Deutsche Bank, used by Goldman Sachs Wealth Management for its wealthiest clients. They still use it. If you've got 50 million, they'll open a private client wealth account for you, and they'll still pick their stocks this way. Okay, and what they discovered is, basically, it is capital and the cash flow that's generated on the capital. Simple. So let's say you buy a sweep machine, capital, you use it for 10 years, all the cost is written off, so you've got no more capital investment, but it keeps producing sweets because you don't need to invest in it anymore to produce sweets. Okay, it just keeps producing the capital. Okay, capital, not consumable costs, capital costs, fixed costs that was once spent, all written off, but the income still comes in. So any of those kind of companies, they discovered if they're in the top 25% by CROCI or cash return on capital invested, they generate a 30% return per annum. Not every year, they don't in that year, not every stock in that portfolio, but on average. So it's another box we wanted to tick off. You can use, because this is difficult data to get hold of, you can use discount cash flow if you wish on that. Can I tell you right at the end something that my hedge funds produced, my asset management company spun out as well? It's a program we spun out, which we've got ambitions to get venture capital funding into, and then hopefully float the damn thing in a few years. This is what you want to look at. That's the holy grail. That's it. That's how we simplify our lives. I want to show you those charts again there. I want to show you the flow charts again, because I think it's really important you take a picture of it, which is simply, you should have this. So when you do it yourself, you've got your own picture. Cash. What should I do? Okay, boom. I assume you've taken a picture on your camera phone, and this is with your portfolio. Okay. If you get risk averse, you sell 10 to 100%. If it's over 12 months, you sell all. If it's dropped 25% from the highest it's been since you bought it, you sell all. In any other situation, you ask yourself, am I risk averse? If so, you sell between 10 to 100%. That's it. Okay, I'm keeping it simple. Now, you might tweak that. You might say, yeah, I like that, Alpesh, but if I've made 100% in the stock, I want to sell 50% or whatever. You tweak it all you want. These are the rudiments. It's like me selling you, I'm a gardener, I've sold you a tree. You prune it as you wish, but at least you got the tree off me. Okay? That's where we are on it. That's where we are on it. So, and that's what, and yours doesn't have to look like this on, say, a Yahoo Finance or wherever else you get these databases. It won't necessarily look like that. And like I said, 15 to about 40 max. Don't go over 40. It's just too much to manage. I've seen it too often with clients time and time again. It goes over 40 and it's just not, it's not something they're going to manage. I want to show you one or two more that I own. So Taiwan Semi, I've got NVIDIA, as I said, I've got. Now, JP Morgan, here's an example of, well, what happens if it doesn't quite work out? Now, JP Morgan was doing fine since January when I bought it. Then all of a sudden, Silicon Valley Bank. Now, it's not dropped 25% from the highest I bought it, so it's fine. There's not something fundamentally wrong with the company. I look at this. It was value, growth, income, cash, all of those things were ticked, and it's flattened. It's going to take longer. Time is money. I wish it wouldn't take longer. I wish it would just go up like NVIDIA has, but it hasn't. Two things can happen with stocks. You're going to think I'm a bit stupid saying this. Either they do that or they do that. But that hasn't fallen where I need to sell it. Not worried. We bought it in January. It's down a bit. I think we're down about 11% on it. Well, you do the maths. You can work it out afterwards. What's the difference between, actually less than that, 135 and 126, whatever the difference is. Okay. That's where we are. And we've got to wait until December 31st. That's fine. That's what happens. That's the process. That's the pen.